The first big mutual fund investing mistake is made when you're deciding which mutual fund to invest in. Now, most people, when they are looking for a mutual fund to invest in, they look at which ones have performed the best so they can get an idea of where to invest. They'll read articles to know which these best mutual funds are. They'll ask their friends what they're investing in, or they'll go to websites that have mutual fund returns data. For example, let me go to Value Research and I will sort all equity funds based on 1 year performance. So as you can see, the best performing fund in the past 1 year is the HDFC Defense Fund with returns of 133%, which is absolutely crazy when you think about it. And that's followed by a lot of public sector index ETFs or funds. Now, these are mutual funds that only have stocks where the Indian government holds a majority stake. Now, the idea behind sorting mutual funds based on returns like this is very simple. You want to select the best mutual fund and make the most amount of money. And I've noticed lots of people take this approach while having hundreds of client conversations ever since I've been licensed in the financial services space in India since 2015. And that's only natural because the human mind finds comfort in investing in a mutual fund that has done well in the past. And that plays a huge role in someone investing in one of the top performing mutual funds of the past. I'm going to go back to Value Research and look at a slightly longer time frame. So over a 3-year period in the entire Indian mutual fund space, you can once again see various PSU-oriented funds have performed the best. They have generated returns of anywhere between 40 and 50%. So let's say you had invested in the Nippon India ETF, which invests in the Nifty PSU Bank Index 3 years ago. You would have gotten annual returns of 45%. That means 1 lakh invested in this particular fund about 3 years ago would have roughly grown to about 3 lakh rupees. Your money would have grown 3 times in just 3 years, which is again absolutely mind-boggling. But choosing a mutual fund based on past performance is a huge mistake. That's because the best performing funds of the past rarely keep performing well in the future. In fact, here's a superb study conducted by Funds India where they have looked at mutual funds in India since 2002. And as per this study, only 1 out of the top 4 performing mutual funds stays at the top for the next 3 years. And that's something that has also held true across different 3-year blocks since 2002. The mutual fund, in fact, that was ranked 160th out of 178 during 2018 to 2020 was the best performing mutual fund from 2021 to 2023. And the best performing mutual fund from 2018 to 2020 was ranked 190th out of 218 mutual funds from 2021 to 2023. And that flip in performance is also true for other funds, where the best performers of yesterday are not likely to keep performing well. This seems absolutely counterintuitive, right, as to how otherwise people approach investing by selecting the best performing mutual funds. And this is even more true across 5-year blocks, where only 1 out of 5 funds keeps performing well. Now, imagine you invested in a mutual fund only because it gave fantastic returns in the past. And soon after you invest in it, the mutual fund starts performing badly. And then you're tired of that bad performance, so you move into another mutual fund, a different one, which you've again picked based only on past performance. And guess what? Once again, the mutual fund that you have selected starts performing poorly soon after you invest in it. In that case, you may think you have been cursed with bad luck. But that's not it at all. The way you select mutual funds based on past performance is absolutely wrong. Instead of choosing mutual funds based on just past returns, you ideally want to look at a combination of factors like down market capture ratio, up market capture ratio, rolling returns, and investing style, all of which I'll be talking about and covering in a different video entirely. So a sub to my channel will be a fundamental game changer for your investments. The second mistake that people make while investing in mutual funds is that they only invest in sectoral funds. Now you may be wondering, what are sectoral funds? The PSU or the Defense Mutual Fund that I told you about earlier is a type of a sectoral fund. These sectoral funds are mutual funds that only invest in stocks from one particular industry. It could be auto, banking, and PSU among many others. Investing in just one sector can be very risky. Because if you think about it, if that one sector does well, your fund does extremely well. Like in the case of the crazy 3x growth that we saw in the PSU banking fund. But the other side of that coin is bad performance, because all your money is exposed to just one sector, and if that does not do well, then you are in trouble. I'll share two classic examples of this. In 2017, the real estate sector was the best performing sector in India and generated 106% returns in just 1 year. Guess what happened in 2018? Real estate stocks were the worst performers and gave a negative 31% return. Then in 2020, Indian healthcare stocks gave a whopping 57% return and healthcare was the best performing sector. But in 2021, that sector gained by 18%, which is not low by any means, but it was the third lowest performing sector. And in 2022, it actually gave minus 11% returns and was the second worst sector to invest in. In fact, even before the outstanding rise of the PSU index, the PSU index was at the same level that it was in 2014 as it was in October 2022. So it's very difficult, in fact impossible, to predict which type of stock or sector will do well in the future. So instead of investing in sectoral funds, opt for broad-based mutual funds where you get exposure to various sectors, not just one. For example, let me share with you the portfolio of Quant FlexiCap, where you'd find various sectors within that one fund. So here's Quant FlexiCap, which has again gained 63% in 1 year, supremely high returns. Do not expect such returns to continue consistently. I'll show you now where this fund invests in across different sectors. And as you can see, it has got all these various sectors and not just one, from utilities, consumer discretionary, financials, energy, materials. And you can see how much weightage they have in the portfolio. And the fund managers of say Quant or other mutual funds, based on their own analysis and research, are always changing the investments in their particular portfolio, and they increase their holdings in certain sectors and stocks and decrease them in others. The third common mutual fund investing mistake is investing in many mutual funds. I see this happening all the time. Some people have even 15 or 20 different mutual fund schemes in their portfolio. Now, when people do this, they want to reduce risk by dividing their money across different mutual fund schemes. But in most cases, when people are buying so many mutual funds, those mutual funds are investing in more or less the same stocks. So even the performance of those various funds ends up looking very similar. And that's where the problem lies, because that doesn't at all reduce risk. In fact, let me show you where mutual funds invest in by opening Advisor Khoj's portfolio overlap tool. I've selected two large cap funds here, the SBI Blue Chip and the HDFC Top 100. Let's see how these two look like in terms of the common stocks they hold. So 52% of the stocks that both these funds own are the same. So as you can tell, if you're investing in these two funds, you're not really diversifying your holdings. You're investing in more or less the same stocks, but just through two different avenues. Now, one actual effective way to reduce risk and even improve portfolio performance is to invest in different kinds of mutual funds. So while building a portfolio, you can consider having one mutual fund for one category. That means you would have one fund for large caps, one for mid caps, one for small caps, one for say value style of investing, one for momentum investing, and so on. That way, through only 5 to 6 funds, you're truly diversifying across sectors, size of stocks, and even investing style. Tell me down below in the comments if I should make a detailed video on how to construct a mutual fund portfolio, and I will make it soon. Now, the fourth big mutual fund investing mistake that you can make is around investing psychology. I'm going to ask you a question and I want you to answer it very honestly. Are you ready? Let's say you had started a 10,000 per month SIP 5 years ago. Now, if you had continued with that SIP today, you would have invested 6 lakhs so far. Here's the question. What would your portfolio value have to be today for you to feel truly happy and satisfied? Is it 8 lakhs, 10 lakhs, 12 lakhs, 15 lakhs or something higher? Now let me tell you, if you had actually invested this money in the Indian stock market and the Nifty 500 index, the value of your portfolio would have been 10.54 lakhs. That's an annual return of 22.35%, which is again insanely high. To put that in perspective, the Indian stock market has returned around 15% annually in the past 40 years. So while a portfolio value of 10.54 lakhs after 5 years of a 10,000 per month SIP may seem low, it's actually not. That's why managing your expectations is very important. Another important aspect of managing expectations involves understanding that the stock market is volatile and that the value of your investments will go up and down routinely. For example, the Indian stock market has gone down by at least 10% in 20 out of the last 23 calendar years since 2000. So the value of your investments and portfolio falling 10% in value is almost an annual event. And here's the kicker. Despite those constant 10% drops, a 5,000 per month SIP with a 10% annual step up started in the Nifty 500 index in January 2000 would have grown to a whopping 1.9 crores today. Now, the fifth biggest investing mistake can potentially cut your returns in half. I'm not joking. This costly mistake involves trying to time the market, where you want to buy low and sell high in an attempt to maximize your gains. While this strategy may actually sound appealing and many people try to implement it, it's important to understand that actually trying to predict stock market movements is impossible. Anyone who tells you they know what's going to happen in the stock market in the future is lying or trying to scam you. In fact, a wonderful study conducted by Zerodha looked at the 5,000 days in the Indian stock market when it was open from October 2003 to October 2023. So a 20-year study. In it, they found that if someone had invested 1 lakh rupees back in 2003, that would have grown to 18.6 lakhs in 20 years. But if someone was trying to constantly buy and sell and time the market, and in the process, they had missed just 10 days in almost 5,000 days when the market had gained the most, their investments would have been worth only 9 lakhs. That's 52% lower than what you would have had if you had stayed invested during that whole time. Now, no one knows which those 10 best days are going to be. But this just highlights how crucial it is to not try to time the market, as even missing a few of the best days can impact and affect the magic of compounding. I'm sharing more resources with you below the like button, so check those out and I'll catch you in the next one.